Hello traders, I welcome you to the official YouTube channel of the Wealth Empire Capital. So today I will be talking about something interesting, a very interesting topic, and it is on the concept of liquidity in the forex market. So this is a very lengthy topic. It's a very important lengthy topic, and so I will be making these videos into three. I'll be breaking it into three series, okay, so that I can have enough time to explain very well for you guys to understand. So it doesn't matter whether you are a retail trader or a smart money trader. I mean, you just need to stick around and get some nuggets from this video, okay? So if this really sounds like something that you really want to learn, then I'll urge you to stick around to the end of the video. And if you're not subscribed to this channel, kindly hit that subscribe button and turn on post notifications so that you don't miss other future important videos. So with that being said, let us jump straight onto the charts. Okay guys, so like I said earlier, this video or this content is going to be in three series, and this is going to be the first series. Okay, so we'll be talking about liquidity in the forex market. Okay, so I have grouped this liquidity into two categories. All right, the first category is what I call the visible liquidity, okay, and then the second category is what I call the invisible liquidity, of which the Asian session liquidity is part. Okay, so today we'll be looking at the visible liquidity in the first series. All right, so when we talk about visible liquidity, these are the liquidity pools that we normally see. Okay, most often when we start trading, we are taught that, okay, if you see a double top, okay, and the price is approaching for the third time, that is called a triple top. You can just, take your sell over there, and then you have your stop loss above structure, and then you target whatsoever target that you want to target. Okay, and then what happens is that you take the trade, and then it ends up smashing your stop losses and then moving in your direction after taking you out of the trade. Okay, and you'll be wondering what happened. It's just because you didn't have the knowledge of liquidity. You didn't understand what was happening in the market. Okay, so whether you are a retail trader, you are a smart money trader, I'm going to explain to you why. Okay, and also we tend to look at liquidity with the wrong confluences. Let me put it that way. Okay, so you cannot look at liquidity without structure. Now this is a primary rule. Structure is always king. I want you guys to get this. Structure is always king. So regardless of whatsoever concept that you are trading, whether you are trading support and resistance, you are trading smart money concept, you are trading chart patterns, structure is always king. All right, so if you understand structure, okay, you are going to avoid certain mistakes. But if you understand structure and liquidity, then you're going to avoid so many mistakes, and you're going to make very good decisions as well. Okay, so to explain, the first type of visible liquidity that we all know is what I said earlier: the double top, the double bottom, triple top, triple bottom. Okay, so this is just going to be a pictorial representation of those types of liquidity, and then after that I'm going to show you examples in real life, like on the charts. Okay, I'm going to show you examples with combining it with structure, so that you'll know how to trade in such situations when you find yourself in one. Okay, so starting with a double top, so we can see something like this. Okay, first top, second top, and then the motive is that when price is coming for a third time, we're told, okay, that when price is coming for a third time, or when you see a resistance or a support being tested, the first, the second, the third, it tells you that the resistance is strong. Okay, so the third one is a pattern, and a common pattern that we know in retail trading as a triple top. And so you are going to take your sales. Okay, you're going to take your sales, and you'll have your stop loss above structure, and then what happens is price takes you out, and you'll be wondering what happened. I mean, you just found your way at the wrong side of the market. All right, so the double top is always liquidity. They are resting orders above this level. Okay, but the market is always attracted to liquidity where there is money. Okay, so anytime you see setups like this, I think combining it with structure, you will know either you should not take that trade or not. But by the end of today, you're going to understand that when you see setups like this, combining it with structure, you are going to stay away from it. All right. So this is the first example in the visible liquidity category. The double top, the double bottom, triple top, triple bottom, they are all liquidity pools. Okay. The second type of liquidity that I am going to be talking about is called protected liquidity. Okay, so this is not a type of liquidity that is known by most people. But when we say protected liquidity, okay, protected liquidity is when, let's say, for instance, using this same drawing here, when you are in a downtrend, okay, you see price making here, it forms a low, and then it gives us a lower low over here, a lower high, and a lower low. Okay, that is why I say we combine this liquidity with structure. So we see that when price approached this supply zone or this resistance, it didn't break through. Okay, it didn't breach this level. It just respected it, and then it fell back. Okay, so this liquidity, this zone here where price respected, okay, is the protected liquidity. Okay, so to put in a short form, when the market is making bearish swings, every lower high is protected liquidity or major liquidity. So it's called either protected liquidity or a major liquidity. So in this scenario, this point here is protected liquidity. This point here is also a protected liquidity or a major liquidity. The moment price breaks through this level, that is when we say that there has been a change in trend. It means that that protected liquidity has been breached. So that leads us to our third liquidity type, which is the target liquidity. Okay, so with the target liquidity, what we are saying is that when price forms, let's say, a lower high, a lower low, okay, this point right here where price is heading to, okay, so price is from a supply zone or a resistance zone, whatever you call it. When price is heading to that point, this lower low over here is our target liquidity. That is why you always see price approaching that side, okay, or that point. Okay, so liquidity always attracts price, so price will always approach a target liquidity. Put everything into summary. What I'm trying to say, using I'm going to use an uptrend scenario. Okay, when we see price making higher highs, higher lows, higher highs, higher lows, and then a higher high. Okay, all these levels that we are looking at here, these higher highs, is what we call target liquidity. Meaning, if you should take a buy position over here, okay, at least you should target these highs. Okay, if you should take a buy position over here, at least you should target these highs. So this is target liquidity. Okay, and then the protected liquidity is these levels in the market over here where price respects demand. Okay, this is a buy scenario, so to be demand where price respects demand. Okay, the moment price breaches a protected liquidity, it means that the trend has changed. Okay, so in this case, the trend would have changed from an uptrend to a downtrend. So now this level is going to be what? Your protected liquidity, and then you're going to have your target liquidity what? Resume again. That is this time around in a bearish scenario. Then what happens to all this protected liquidity? They are going to be internal liquidity. Okay, I'm going to talk about that in the second series. So let us jump straight onto the chart, and then let me show you some examples with coupled with a structure, so that you know how to take these kinds of trades when you see them on the market. Okay, so first I'm going to break this down without structure. Then after that, I'm going to explain to you why all these positions were taken at the wrong side of the market. Okay, all right, so I'm not going to talk about trend line liquidity today. It's going to be in the second series, so let us focus on this one. So double tops, double bottom. So we were told, okay, we see price come here for the first time, creates a very nice bottom over here. We see the rejection, a very big candle engulf whatsoever. Then we know that, okay, when price comes here the second time, we are going to do what? We are going to take that buy to the upside, okay? Because we think that that is a potential double bottom to be formed, and so you're going to capitalize on that move, all right? But what happens? We take our trade, okay, like this, and then we have our stop losses just below structure, okay, take just below this wick. And what do you see? Price just, just takes you out, and then it moves in your direction, and you'll be wondering why. Okay, first of all, you are reading structure the wrong way, and then secondly, you are taking a trade at a point where you're not supposed to trade. Okay, the second scenario will be this point over here. Same thing, double bottom scenario here. Okay, so price has approached here for the first time, then the second approach, and then like we always told, the third touch is gold. Okay, but what happens? You take your entry on the third touch, like we always told. Okay, stop loss right below what? Structure, 10 pips. What happens? It just smashes you out, and then it moves in your direction. Okay, and you'll be wondering what happened. It's just because you find yourself at the wrong side of the market. There are resting orders just below this level here. So this point is a liquidity pool. Okay, the third touch is not gold. It is always not gold. It can take you out, especially when you have scenarios like this. All right, and then also when you are reading structure the wrong way. Okay, now this scenario over here, we can see probably you can get this one. Okay, you have price come here for the first time, the second time we are like, oh, okay, double top. Okay, we take it, and then yeah, probably your target is to this place. You can just take something 56 pips or 6%, whichever way that you manage risk, or you do your risk management, is up to you. So you see, take profit hit, you are glad, you are happy. Okay, and then you see this low over here. You see this low over here. We have some strong rejection over here, blah blah blah, and then you set your limits, okay, over here. And as we always told, your stop loss right below structure, just like that. And what do you see? Price just takes you out, and it moves in your direction. Okay, you found yourself again at the wrong side of the market. Why? Because you are taking the trade at a point where there is liquidity. I'm going to explain to you why this point was evaded, or why your stop loss was evaded. Okay, so back to this scenario again. First touch, second touch, third touch is gold. Okay, we see a pin bar here, strong rejection, engulfed candle, blah blah blah, and then we set our limit. Okay, stop loss always above structure. So let's say in this scenario 14 pips, and then where are we targeting? We are targeting at least to these lows, or let's say 1:3, whichever way you want. Let me be generous, 1:4. Okay, what happens? Price gives you a little bit of movement. You are happy, oh, price is moving my direction, and before you realize, just comes back, smash your stop loss, and you're running at a loss, and you'll be wondering what happened again. You find yourself at the wrong side of the market. Okay, this will be the last scenario over here. Then I will explain why all those trades run at a loss. So again, a potential double top. You have the first top, you have the second potential top coming. Okay, you see a pin bar here. Okay, we are like, oh, rejection, blah blah blah. Again, you take, or you set your limits, your sell limits over here, like we always told. Stop loss above structure. You can see just above structure, about 9 pips, and you're looking forward to what? At least, let's say, let me be generous, let's say 10%. Okay, you're looking forward to take 10%, or let's say even 100 pips. Okay, what happens? Price just smashes through. Okay, so why are all these trades getting taken out? Okay, why are all these trades getting taken out? The first thing is because of structure, and you need to understand where liquidity is. Okay, so let me start with structure. So this is the mistake that you were making as a retail trader. I trade demand and supply coupled with some smart money concept. All right, so on the H1 time frame, what do we see? If you understand structure, what do we see? We see price making a low over here, makes a higher high, right? A higher low, and then a higher high. Okay, what happens? This higher low over here gets taken out. So it means that H1 is bearish. Okay, and what did I say? I said that when a protected liquidity gets taken out, it means that the trend has changed. Okay, so when price is moving like that, higher highs, higher lows, higher highs, higher lows, when the last protected liquidity pool or liquidity point gets taken out, it means the trend has changed. And like you always know, the trend is your friend. So you need to trade in the direction of the trend. You don't trade against the trend unless you have a tested strategy that allows you to trade against the trend. That is fine. But then you are always advised to trade with the trend, not against the trend. So when this protected liquidity gets breached, you should know that the trend has changed. Okay, so price definitely will respect this point as a protected liquidity, as the new protected liquidity before moving. Okay, so this level here is going to be a target liquidity. Okay, and you are standing in the way of price. So if you are looking at this point as a potential double bottom, and so you're going to take buys from here, you are standing in the way of price. Okay, so price was making higher highs and higher lows over here. Okay, and then this protected liquidity, you should know, this protected liquidity got swept. Okay, it was taken. So what happens? It means that after this break of structure, we are bearish. So we need to look at the market in a bearish sense. All right, don't trade against it. So it means that, again, this level here is going to be what? Your protected liquidity. Price is not going to breach. The moment it breaches, then you should know that the trend has done what? It has changed. Okay, that is why you see price just came in here, even though it didn't tap in perfectly, but you can see that price approached this area and then it fell back. Okay, so here is a target liquidity over here. After taking this protected liquidity, this low becomes a target liquidity. So when price is coming down, you are supposed to expect it to what? To raid this point. Okay, so that is why this double potential double bottom trade failed. All right, again, another protected liquidity over here. Okay, so if price should retrace to the upside, it should not breach. The moment it breaches, that is a change in trend. Okay, so in this scenario, what do we see? Price came in, respected this level, and then again, what do we have here? We have our target liquidity here. So at least price should get to this level. Okay, so what do we see? Price started coming down, 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 and at least it smashed that level. Okay, so if I should put my ray line 2 over here, you can see it's smashed. Okay, so if you're taking a sell here, you are following that H1 trend, and so definitely at least you should get to minimum this target liquidity, and that's what happened. And so if you are looking to take potential double bottoms over here, you realize why you were smashed. It means you are standing right in the way of a target liquidity, and that is why price will always crash you. Okay, great. You can see with this double top, it didn't take you out because the market was actually moving down. Like I said, it was actually moving down, and so you were flowing with the trend. Okay, that is why it didn't take you out. All right, that is why it didn't take you out. If you took this double top scenario sales, you're not taking out because you were flowing with the trend. All right, with this double bottom scenario over here, you are trading against the trend. You are buying, you are trading against the trend. Okay, you are trading against the trend. And so if you should enter a buy in this scenario, you are going to be swept. All right, so you always have to know where you are standing before you take that decision to enter a buy or a sell. Now, this how do you call it, this triple top scenario that also failed. Why did it fail? Now, after price making a higher high or a higher low, price will have to retrace. Okay, so if you watch carefully, price after making this higher, lower high, lower low, okay, it was retracing to at least this protected liquidity over here. Okay, in this scenario, it breached that protected liquidity and it led to a change in trend. Okay, so at least price was retracing to this protected liquidity. And so if you are selling, again, you are against the trend, because you can see price making higher highs, higher lows, higher highs, higher lows, you know, higher high. So you shouldn't stand in the way of price. You should always go with it. So if you are looking at this as a potential triple top, I mean, you're going to get smashed, just like happened here. Okay, and then the last scenario over here was this potential double top that we were looking at. So we cannot anticipate a break of structure until it has happened. All right, we can't anticipate a break of structure. I wouldn't be able to tell if this protected liquidity will hold or not. So in this scenario, you can see, so I always need to wait for confirmations, entry confirmations, before I take that trade to the downside. So in this scenario, what did we see? This protected liquidity got breached over here. So it means we have a change in trend. And if we have a change in trend, what happens? It means that this low over here, this demand level over here, becomes the new protected liquidity. If I swipe to the right side, you're going to see that price followed that trend. Okay, so let's just swipe to the right side and we're going to see, you see, so after price breaching this protected liquidity, price started what? Moving in an uptrend. All right, so this point here becomes a target liquidity, your next target liquidity, because there has been a change in trend. So what do you see? It takes it out nicely because it is target liquidity. Okay, excuse my drawing, let me use the real line too. Takes it out, okay, because it's target liquidity. And then price just went up, continue with the uptrend. Okay, so that is it with this series. Always make sure that when you are taking trade, whether you're a smart money trader, whether you are a retail trader, I think this liquidity scenarios was more of retail style. You always have to make sure that you are in line with the trend. You shouldn't find yourself against the trend. Don't trade against the trend, else you are always going to get smashed. Okay, so guys, this is where I'm going to end today's series. If you found this video important or helpful, kindly like this video, kindly share this video, and don't forget there will be a second and a third series that I'm going to break the other types of liquidity, which is much more of a smart money liquidity point or liquidity inducements, like they say. Okay, I'm going to show you all those tricks in the market. So guys, see you on the next video.